Diving into the portfolios of the ultra-wealthy unveils a surprising preference: illiquid assets. Why does this counterintuitive strategy appeal to them? Let's uncover the hidden advantages they see that most miss. In this video, I will discuss 7 of these advantages and why you might consider this in your own investing approach. Hi friends, I'm Cody Koch. If you're new here, I'm a 25-year veteran investor, trader, and business owner. On my channel, I like to talk about investing, trading, and business concepts. So there's this thing called the liquidity premium, which is the tendency for highly liquid assets to sell at significantly higher prices relative to their underlying cash flow compared to less liquid assets. So simply this means the more liquid an asset is, the lower the rate of return you can expect from that asset over time. So examples of liquid assets would be cash, publicly traded stocks, publicly traded bonds, options contracts, and futures contracts. So some examples of illiquid assets would be private ownership of businesses, real estate, private lending, and private equity. Generally speaking, it is believed that liquid assets are better, safer, provide more freedom and flexibility, yet the wealthiest have a strong tendency to invest aggressively in very illiquid assets. A study done by KKR back in 2020 found that ultra-high net worth investors, that is, investors who have net worths over $30 million, put a significantly larger portion of their net worth into illiquid assets compared to high net worth investors, that is, investors with a net worth between $1 million and $30 million. On average, ultra-high net worth investors put approximately 50% of their portfolios in illiquid assets compared to 25% for high net worth investors. On the other hand, high net worth investors put approximately 50% of their portfolios into publicly traded stocks compared to ultra-high net worth investors who put approximately 30% of their portfolios in publicly traded stocks. High net worth investors put a little over 20% of their net worths into bonds. Ultra high net worth put approximately 10% of their net worth in bonds. The one exception to this was cash. Ultra high net worth put approximately 10% of their portfolios in cash, whereas high net worth investors had approximately 3 or 4% of their net worth in cash. One interesting fact I observed several years ago was how much ultra high net worth investors have a tendency to buy a lot of businesses, invest in private equity and real estate. If you are enjoying this video, please hit that like button and subscribe. So let's get into the 7 advantages of investing in illiquidity. Number 1, higher rates of return. According to research I've seen from JP Morgan, less liquid assets over the last 20 years have produced 4 to 5 percentage points higher in annual returns compared to the S&P 500. So if the S&P 500 produced average annual returns of 7%, illiquid assets produced returns of 11 to 12% per year. Now I do want to say that this is a controversial subject. There is actually debate in the finance community whether or not the liquidity premium actually exists. In my observation, my experience, it actually depends on the nature of a particular asset. It's not always true. With every asset, it depends on some details. What I can say with confidence is that yes, in my experience, less liquid assets do in fact have higher rates of return than more liquid assets. So for example, in business acquisitions, small businesses have a tendency to sell 1 to 5 times EBITDA. Medium-sized businesses tend to sell 3 to 7 times EBITDA, and large publicly traded businesses have a tendency to sell 8 to 15 times EBITDA. Generally speaking, the smaller the business, the harder it is to sell and therefore the less liquid. As businesses get larger, especially when they become publicly traded, their shares become significantly more liquid because the available pool of investors grows significantly. Number 2, lower tax and transaction costs. Now, I know that transaction costs for illiquid assets are usually quite high. However, and what I'm talking about here is in many cases due to their illiquidity. In most cases, investors hold the position for much, much longer than they would if it was actually far more liquid. For example, in any given year, very large publicly traded companies, their shares trade so often that in fact the entire company, in terms of the overall outstanding shares, trades hands at least once a year. Whereas in large privately held businesses, the shareholders may own the position for 30, 40, 50 years. And so in that sense, there's significantly lower transaction costs in the case of highly illiquid assets. Also, owning these assets for so long significantly reduces capital gains taxes. As long as they do not sell it, they do not trigger a taxable event, and therefore the asset can grow without a significant tax burden. Warren Buffett has often talked about how much investors underestimate the true costs of taxes and transaction costs. Number 3, it protects you from emotional selling. So owning something like real estate or a private business, you do not see a daily price movement like you do with publicly traded stocks. Also, if something goes bad with the investment, you have to take a significant amount of time to think about actually the process of selling it. So generally speaking, less liquid assets actually require the owners to step back and really think about their long-term plans and goals. Number 4, it's more stable in chaotic times. Liquidity is not a constant, and it actually changes over time. In chaotic times, liquidity often completely completely disappears. But assets that are more illiquid actually fare significantly better in these times because, frankly, nothing's necessarily changed for them at all. Number 5, more great deals. Illiquid assets have a tendency to trade in very inefficient markets. And so because of that, investors can often take advantage of that situation and find significantly more deals that are more favorable to the investor than you can in highly liquid markets. Number 6, low correlation and diversification. Owning a private business can be very, very uncorrelated to not only US stock market, but also very uncorrelated to other private businesses in different industries. It's the same with real estate in many cases. Number 7, better alignment among investors and management. And so with many publicly traded companies, the investors can often clash with the managements of those companies because they have different goals and objectives. In many cases, management of these companies are more focused on the next quarter, whereas long-term investors would be more focused on the next 2, 3, 4, 5, 10 years. In other cases, other investors within publicly traded companies may only be focused on the next 24 hours in a particular stock. For this reason, less liquid assets have a tendency to have investors and management that are all aligning and going in the same direction because, frankly, all of their holding periods are in the same time frame, and they're all forced to have the same time preference. So in this video, I've talked a lot about how some of the wealthiest people invest a huge chunk of their portfolio in some of the least liquid assets. Related to this subject, I previously did a video discussing the 2 biggest secrets among billionaires. You can watch that video here. Please hit that like button and subscribe, and I'll see you in the next video.